right, well, welcome to our Markets Happy Hour podcast here in lovely Salt Lake City. The snow is falling. We have the Wasatch Mountains here on the screen, and delighted to have some people from very different sides of the spectrum, from emerging markets, public equities, to venture and private equity, to give contributions as we move along. So let's start by sharing the screen. Great. So this is what we cycle through every week. We talk about inflation, geopolitics, lots to talk about there. Has been interest rates and how they relate to fixed income holdings and a portfolio as a whole, equity markets globally, and other asset classes. So depending whether we get the time to turn to other asset classes today, we'll be able to talk about that. And what is on the topic for today? Well, tariffs seem to be on the table again. These slides were done hot off the press because the moving target of tariffs seems to be keeping markets on the edge of their seat. We did hear Scott Bessent this week talk about Wall Street doing okay, but tariffs being designed to boost Main Street. And I think this Wall Street versus Main Street dichotomy is a really interesting one to talk about because I happen to think they're quite fundamentally inextricable. And to target Main Street and forget about the impact on Wall Street could be a dangerous slope to go down. And since I may as well use as many skiing analogies as I can in this particular podcast, given where we are. And then the last is a little bit of alliteration around the elation in Essen, given how happy everyone seems to be in Germany about the turn of events, the release of the fiscal brake there. And seems like more spending coming through in Germany that seems to have boosted sentiment in developed markets. And maybe we can hear whether there's a similar sentiment cascading through emerging markets. It'd be great also to hear how emerging markets are reacting to tariffs. So I'll quickly kick off with a few stats. This was actually from last week. Last week, we spoke about moving from Trump 2.0 to Trump 2.1. And Trump 2.1 was a bit of a reckoning. We lost the froth of the post-election victory. We were seeing that the S&P had started to fall. Bitcoin, despite the tailwinds of Donald Trump's regulatory setup, had started to fall. The dollar was weakening and the US Treasury yield was falling. So this all seemed like it could be according to a plan. And whether it was, in fact, because some of these, the low Treasury yield, a low dollar, would have been something that Trump would be targeting, perhaps not the low movement in the equity markets, not the low movement in Bitcoin. But this could have been according to plan, or it could have been a reaction to some negativity around the market and some concern around the market. So the market is really vacillating. We've heard it described as a ping pong market, not a scientific term, but I think we can understand just how much markets have been moving around. We've seen it in fixed income, and we're certainly seeing it in equity markets. So that's been the up to date. But what are we seeing in terms of inflation? Well, I've called this eggs, ECB, and revisiting zero real rates, because it seems that last week we were speaking about eggs, the price of eggs a lot. That has been completely replaced now, it seems, with the new fervor around tariffs, as this was a less than 24-hour time period between tariffs and when they were being discussed and actually coming into effect. But what's happening in the rest of the world? So not much movement on US inflation this week anyway. We're not talking about eggs quite as much. The ECB, we are seeing that there is focus on inflation there. And we know that inflation there is coming down, but around about the 2.5, 2.6 level. But we do also know that the ECB has just cut rates to 2.5%. So that means that essentially we're at a zero real rate environment again. If inflation is 2.5, the rate is 2.5, we're essentially quite a bit lower than we would be in the US. But yet the euro is rallying against the dollar, which seems to be a little counterintuitive given where the interest rates are. But this has been a dramatic turnaround in the euro, which is only just one symptom, I think, of the other developments in Europe. But I'd say for now, not much to say on the inflation side. What was notable, however, in Europe is that this may be it as far as the next round of cuts go. There did seem to be a sign that there might be a break coming on the monetary side, and that was something interesting. So I'm not sure whether any of you are watching Europe or have any thoughts on the ECB's quite, I'd say, keen rate cutting. Compared to the pause that we're seeing from the Fed. They certainly seem to have not drunk any Kool-Aid around economic strength. They seem to be quite concerned and don't want to be behind the curve. And that seems to be their angle at the moment. But 6 rate cuts since June, not to be ignored. And what's happening in equity markets? Well, they have been quite sour, I'd say, in response to the tariff turmoil. We've seen a spike in the VIX. This has actually been in our portfolio. We've been quite keen on some private assets at this time because we know that the volatility that's been experienced in equity markets has been quite low and probably unrealistically low, and that it was due to spike. We can see here that the tariffs have really been the highest we've seen year to date. In terms of the spike in volatility, and only two previous times we have to go right back to spring of 23 to see when we had a similar spike, SVB, and then with a hawkish Fed just before the end of the new year, a bit of a tantrum there. So and then this, of course, in the middle being the yen carry trade unwind. So an unusual spike in volatility, and likely that is feeding in to some of this concern around consumer sentiment, which is something that we've seen has been also quite sour in recent weeks. And interestingly, this has been the time then for low vol stocks to reappear and rear their heads. It seemed that years ago, low vol was the way to invest in active management. There was a persistent outperformance of low vol factor funds, factor ETFs. It had been a little bit surprising, given that is here the pink. If we're looking at the pink and the red and the black lines in this case, we can see that having kind of lagged the S&P just at the end of last year, they've really started to outperform. Low vol has been a surprising sort of bright spot in the markets recently, and whereas we've seen this fallout in the higher vol stocks. So a bit of a rotation, nothing too meaningful at this point to say that we are in rotation territory, but interesting that low vol is starting to look flavor of the month again as volatility has emerged. Equally, we talked about the Trump trade for many, many months, and clearly, whether it's spoken or unspoken, there is a strong desire of this administration not to see a market crash. It seems that there is a strong correlation between sentiment, belief in the robustness of the America First and the performance of the stock market. So now the question has emerged of what is the pain point at which policy might reverse itself. So would that pain point be when there's a technical correction in markets, or there's a sense that, now we've seen that markets have essentially erased all of their post-election gain? Is that a kind of a technical level, perhaps, where there might be a backtracking? We don't know that yet. This doesn't seem to have featured yet as a policy direction, as tariffs are discussed. But I think we all know at the back of our minds that there is an unwritten desire not to see markets crashing.
Well, I would say that what's driving the market right now is uncertainty, and that is going to lead to ongoing volatility. And it's just by definition of how decisions are being made and how they are being withdrawn soon after being made. I think the manner in which, certainly in the US, the markets are being impacted is unpredictable on a daily basis. So whether this is the floor, it's hard to say, but volatility certainly will be, I think, in play while we have the current administration.
And it's interesting because that uncertainty, we know through backtracking, is certainly there as far as pronouncements are. But what I've been wondering is how much is that trickling through to corporate decision making, and how much is it affecting international companies? I mean, firstly, on the corporate decision making and the private equity venture side, do you see if companies pausing on expenditure, not knowing whether they need to introduce another branch of the decision tree?
I think what we're seeing right now is a lot of wait and see. We have a lot of companies poised for IPO. We have no clarity on when the IPO market will reopen. Meanwhile, we have a lot of development and innovation in AI, which is going to have significant impact across almost every sector. So what happens in Washington is going to have a significant impact on how these later stage companies certainly play into the public market space. And on the early stage side, I think they're just hoping that they are betting on the right horse and that they are not innovated over, right. Because innovation is happening faster and faster, and it's very competitive.
And it's not just policy, it's tariffs as well. It's tariffs, it's direction of tax, etc.
There are so many elements. We have a 5 or 6 that at the moment we're paying attention to, but we have no assurance on when those will be decided.
And part of the reason I have such a focus on developed markets here, ex-US, is because there seems to be now their whole existence seems to be a lot based on reacting to the US administration policy. We've had a lot of focus on Europe. It wasn't the crosshairs of JD Vance's speech, and we know that with the Russia-Ukraine, it's on their doorstep. In emerging markets, do you see that there is now a calculus at work in terms of gaming next steps?
Yeah, in emerging markets, there's the probabilities weighing Trump 1.0 versus Trump 2.0. China's gone through Trump 1.0 once. They shifted a lot of their manufacturing to Southeast Asia. Similar to tech supply chains in Korea, Taiwan, they've shifted to other markets. Mexico is building capacity outside, and so you see a lot of this weighing tariffs and what they would be and how we will react and what will the impact be on the business and how much would our customers share that tariff cost versus us. The other thing from the emerging market side, maybe we forget, but when we talk to companies, the currency helps when it devalues. And so we saw a significant devaluation of most EM currencies over the past 4 months since Trump was elected. And so a 20% tariff, but then a 20% devaluation of the Mexican peso actually puts you at about parity. So some of the companies we talked to in Mexico, for example, are saying at this current exchange rate, we're actually not too far impacted if a 20% tariff is instated because of the peso rate right now. The other thing I would add on the tech side is, when the market was watching so carefully when Facebook and Microsoft announced their CapEx plans and Taiwan Semiconductor for 2025. And they all announced pretty bullish CapEx plans.
Yeah,
So
yeah.
they're still moving ahead. And that has reverberated across the Asian supply chain of technology, that technology is feeling pretty good, that Microsoft AI are going ahead with their AI servers. And, maybe China takes some market share from NVIDIA, or maybe NVIDIA won't get all of it. So I think Asia's feeling okay about the outlook looking into 2025 because of those CapEx numbers.
That's an interesting thing. It is not being equally felt. I don't think anyone has made the currency point, so I think that's very well made.
Yeah.
And as far as uncertainty, I think that is very real. There's a sense that there's a very real sense of being not able to plan and not able to spend, and that seems to be the part of the problem. So just in terms of where else are we seeing another full circle of terms of the US stocks go down, but the treasuries now actually looking like they've done just the same. So would this be another rotation? Again, it makes it difficult when you're running a portfolio to really deal with these type of rotations and essentially the volatility in terms of the equity movements, but definitely a time to be wondering. Another very interesting chart is this year's Wall of Fame, and this gets to a little bit of the non-US exposure. When we have the previously we would have looked, this is across the MSCI world, what is it when the leading stock is the German defense stock? We know that we're really in a kind of a territory, unprecedented territory. Certainly, these would have been the sleeping stocks, particularly given the expenditure. Equally, CVS Health, firmly in the defensive vein. And just seeing Rolls-Royce, even a stock that wouldn't have been seen as it's almost like the definition of an old economy stock. So clearly quite a flip in terms of where the Wall of Fame has been, which in our view is only more evidence for the reason why we should have diversified portfolios that have core equity exposure, well spread across the cap spectrum, well spread across sector, and not have been too tactical in terms of calling the top. But definitely, if for the long-term core holders, this would be a validating chart to look at. When it comes to tariffs, I think it's just important to kind of go back and see, well, why do we get here? Where have we got here? And clearly the size of the US trade deficit is clearly pressing on the president's mind and has been since 1980, I think. So it is not a new philosophy. And this is at a record 131 billion. Why is it this high? If we look at the US economy doing so well, and by all accounts, it was the US exceptionalism, the juggernaut, it was doing well. Why do we have a trade deficit, and is it necessarily a bad thing? I think this is some of the philosophy that's actually being debated right now. Arguably, the reason it was a record 131 billion was because there was some stockpiling going on in expectation of tariffs. But equally, strong dollar, another suggestion as to why we would have had this imbalance. But clearly now reaching extraordinary levels, and that's this kind of the story of the tariffs. But as we can see, we have now, it seems, a reprieve in the last 24 hours. It seems now it's not just car makers, it's a broader swathe of goods that are now captured into this. And I don't know, maybe you spend time with other governments, how do this kind of flip-flopping, which is maybe, or the boy who cried wolf, perhaps, or it's a tactic. There was a suggestion that the strong tactic was it was a negotiation tactic, and then reciprocal tariffs are the reality. How is that viewed in a foreign, in the conclaves of foreign governments?
Yeah, I was living in Hong Kong during Trump 1.0, and so was daily conversations with new tariff announcements and trade wars. It is taken very seriously. I mean, that the companies are having to move billion-dollar manufacturing plants based on how President Xi and President Trump get along that week, right? And so it's a major impact. They feel the uncertainty just like we feel the uncertainty. But businesses are doing their best to adapt and evolve, and the powers that be at the top are going to make decisions, and then businesses are going to have to adapt and do their best in that situation. But I mean, being in Asia during, Trump 1.0, it was uncertain, it was hectic, and you were seeing a lot of factories move to Southeast Asia or Mexico. Still, even to today, I mean,
The nearshoring, as well,
yeah,
or the neighbor.
yeah. I mean, you go to Mexico, and it's Chinese businesses after Chinese businesses setting up plants on the border in Mexico, similar in Vietnam.
Yeah.
And so whether that would be cracked down in the same degree as, if the plant is in China or Taiwan, remains to be seen. But anyways, it's businesses making major decisions. And I think, governments around the world are waiting and uncertain, in companies as well.
Yeah.
Mexico, Brazil, Eastern Europe, even India it's uncertain,
Yeah.
and you don't know what you're going to wake up to the next day. And they're all running scenario tests of, okay, if we get a 25% tariff, what will we do?
And interestingly, these are not decisions that are easily made. I mean, relocating a plant, the lead time for that, 10, 15 years.
Yeah.
So maybe it's getting shorter, but it's certainly, these cannot be done. But what I mean is almost like the sole focus right now is reaction to the next pivot. And this has become, I would say that, go ahead. Yes, please, yeah.
It's a small anecdote, and it's local to both your and my origins in Ireland, but a conversation between the Secretary of State, Marco Rubio, and Simon Harris in just this week. The US report of the conversation said that they discussed the trade deficit, and Simon Harris said, we did not. So the US is actually promoting the fact that they're talking about it, because it is a lot of bluster, or at least it is, they are trying to make countries concerned or pay attention.
Yeah.
So there's an as with everything else Trump related, there's an element of theater about it. And that was quite an unusual thing for a government to deny that it was part of the conversation.
Yeah, it just gets to the flooding of the zone that we're all dealing with. And I think that this is why markets are uncertain, why the consumers frail, and why we are, some consumers, as this headline shows, not all consumers, but that why we are, I think, in a position that this, moving on to cognitive dissonance. I think for years I've been saying, if everything's going so well, why do I feel so bad? Or why do I feel at times? And I think this is because we all knew that this K-shaped recovery had continued since COVID. We knew the rich were getting richer. We knew that the blue collar worker was living on the breadline. Their savings had run out. They were really experiencing the pain point of inflation in a very severe way, the regressive way it affected. To read today that the unbelievable spending of American travelers had boosted the airlines, Lufthansa as well as Air France, KLM, because they were now able to sell first class tickets for $24,000, return tickets to Europe, is clearly a sign that at the very top echelon of US society, there is a very robust consumer. On the other hand, at the lower end of the economy, the consumers are quite a bit less enthused. They not only consumer expectations are low and falling, they also are still expecting more in the way of inflation. Interesting, JP Morgan strategist David Kelly spoke today about how we seem to be confusing the economy with the business. I thought this was an interesting kind of concept, the idea that in a business you can cut costs, fatten your margin, and everyone's happy, more profitable. That cutting costs, like Doge, for example, in an economy doesn't work that way. There are collateral damage done by that. That naturally crimps your demand. You cut your costs, you crimp your consumer, your demand function. So I think this is sort of a nuance. There's a lot of economic rules that don't necessarily apply, and the nuance is in the detail always. Another part of detail is the idea that tariffs would be beneficial for the Main Street company, the small cap, the mid cap, as well as the consumer. And I think that this may have been the doctrine at a time when there was not such high stock ownership by individual consumers through their 401k, through their or even through their house, the equity there. So clearly, I don't think we can divorce the two, and I don't even think President Trump would want to divorce the two. So I think what we need to be careful about targeting Wall Street and Main Street, because I think it's pretty consensus from all economists that tariffs would be bad for both. Getting back to Doge, one of the interesting points that came up last week was about the climate of austerity that Doge kind of was really just a part of, and whether that austerity would be starting to affect the consumer demand and the consumer just outlook. And I think it's true, it does. I think when there is that, you talked about uncertainty affecting companies and governments, but when you're a federal employee with a lifestyle that is tied into a low risk position, or US aid, which we know, I know that you do a lot of work in emerging and frontier markets. This is the soft power that is now being essentially surrendered through cutting that. And I think that austerity climate, having spent time in Europe during times of austerity, it's a fairly bleak time. Lacking low hope, no optimism. There isn't the borrowing. There may be low rates, but there actually, ironically, is not the borrowing, because there's too much of that kind of cat under the mattress mentality that is not optimistic and fertile for growth. So I think this is again where some of the economic doctrine gets confused, because we can't always assume. So Doge was not really in the headlines this week. We were more focused on the joint address to joint House of Congress, but we know that this is still chopping away or wrecking away in the background. So we would just wait for the latest, although they are rehiring some employees, it looks like. So it seems that there is a bit of back and forth there. But this is then Elon Musk is getting a disproportionate amount of attention, and close to Tesla taking a hit, as it now is close to wiping out its gains. But I'm not sure whether you've any views on the austerity point, whether that you've seen that mentality is starting to take hold, or is it still rah, America first and stronger optimism?
I think your K-shaped recovery is behind. There are some who feel this is all going to be good and that they will come out fine, and there are those who are less aware perhaps of all the details of all the contributing factors, but they are not feeling any better. And I think there's a natural feeling of concern, which does feel like it's building. Maybe it's the more demonstrations outside Tesla dealerships. Maybe I'm seeing a little bit more in the headlines of pushback, but it's still on the margin.
I don't even remember what day the showdown in the Oval Office was at this point. Friday. Okay, so this has been since the last podcast. Then I think that was kind of that was a watershed moment in terms of at least a schism that was developing, but in international relations. I don't think being in Europe between JD Vance's speech, which seems to have galvanized a lot of Europe around defense spending and a commitment to being going it alone. That does seem to, I think we will look back at those as being pivotal moments.
Another a point of austerity that I've seen is at the university level. So we have interns, and I'm connected with BYU in Utah. And I've heard from students in the past couple of weeks that they are affected by either jobs that they were looking to go into because USAID and other jobs are being cut, but also I heard that biology students and science students lost their scholarships because they had been affiliated with grants, and those grants were cut as part of DOGE. And so you saw students lose their scholarships last week. And so, filtering down to university, job placement's low right now. You've seen it at Ivy Leagues, you've seen it across the board. I think you're feeling that those impacts are already starting to reverberate in the colleges and placements.
And that's going to take its toll. That's why I think we're not really capturing this in the unemployment numbers. The unemployment numbers are
Exactly.
not even close to capturing the outlook or the type of jobs these students have to take, whether they're commensurate with their qualifications.
Yeah.
So I think that's a great observation. Because opposed to Europe, and I'm just mindful of time here in terms of what we're going to cover, but the Europe, on the other hand, is also, despite that we still have somewhat high growth here, although according to recent forecasts, immediately after the tariffs, it went into the negative, according to the Atlanta Fed. But in Europe, we're looking at 0.9% growth. It was 0.6%, 0.8%, I believe, in the UK. At high uncertainty, this came from Christine Lagarde, high uncertainty both at home and abroad is holding back investment and competitiveness. Challenges are weighing on exports. And I think that she said it, well, we've discussed it, she said it, it's clear, it's on everyone's mind. And they've had six interest rate cuts, but 6 successive downgrades from growth in 25. So, clearly things are looking a little bit bleak in Europe. And this is last week we spoke about Europe being in the crosshairs, an afterthought of the world. It's interesting, despite all this and the 6 cuts to growth, there seems to be a turning of the sentiment, at least in Europe, just this week. Maybe that was galvanized by a response to JD Vance's speech. Maybe it's a look in the mirror and realizing that fiscal breaks and lack of fiscal stimulus are not going to work going forward. Interestingly, though, because we are now seeing a lot more spending likely to come out of Europe, particularly on defense, we are also looking at European, whereas the US may be at a saturation point. This, I think, is the dichotomy here. And Europe, but as stimulus, we have the idea that Europe is now looking to spend, I think it's going to be quite significant, close to €1 trillion spending coming from a place of, whereas the previous spending level would have been probably a fifth of that. So that type of stimulus coming out of Europe, it has caused a jump in bond yields, that their biggest daily rise since 30 years, reunification. So that's a sense that, well, how do we pay for armies? We don't pay for them overnight. Clearly, there's a lot riding on this new expenditure. And Germany traditionally had been very conservative, so they had not had a stimulus like this. But despite the fact that bond yields have reacted that way, the mood on the street seems to be quite positive in terms of where the fiscal break, just go back there, that the end of the fiscal break sits into 900 billion, close to $1 trillion in spending. And it seems that the mood is giddy in Germany at the moment. It's incredibly excited. This, of course, will bode well. If we look at where the money was going to be spent, decarbonization, which may be, well, a lightning rod to some members of the administration here, but Europe has pretty much dug in terms of decarbonization. We know that's coming. Local infrastructure, probably quite neglected there. Rail network, it's a good one. Interstate highways, new housing, and this is the investment required. But we know that not only is defense doesn't even really register here, but we know that defense is likely to be a large part of that now. So a lot more spending coming, a lot less of that kind of the more, it was restrictive policy. But the interesting point there is that now pairs with the ECB. If we think of the fiscal and the monetary kind of 2 pedals, if we are going to be opening the floodgates for fiscal stimulus, that would be a sign of the ECB then maybe reining in its monetary stimulus. And there did seem to be a suggestion that there would be monetary policy is becoming meaningfully less restrictive. So Christine, at least in the ECB, they think that they're done now, so that they don't need, they're already at the zero real rates, and they may not need to cut rates anymore. They may leave it to the fiscal spending to take care of that. So a very interesting time in Europe. We've been showing for some weeks just this dispersion in performance in European and US stock markets. Even on the mid-cap side, the idea of more spending in Germany sent the German MDAX index kind of shooting right up, whereas the S&P mid-cap remains unloved, despite the fact that tariffs should bode well for mid-cap. I think there's a kind of a lot of hope and an optimism around US mid-cap, but not a lot of in reality. I think we have to remember this optimism in Europe is even more interesting given where we've shown this chart before, where the GDP growth inevitably will be lower across the board with tariffs in effect. And this is just 10% tariffs, never mind with higher tariffs. So clearly there's a real concern that Europe is going to suffer from that, but there seems to be that optimism around it. So I was going to end it there. I have for coming and for sharing your insights. It's really interesting to have both across the spectrum, from the venture to the emerging market public equity.